like to now welcome up to the stage my panelists today. In no particular order, we've got Terence van der Hout from Commodity Discovery Fund, Angelos Damascus from Junior Gold Fund and Sector Investors, Torsten Denning from Linkius Capital, Kathy Moyes from Patterson's, and Kagan Wang from Tieto. So, gentlemen and Kathy, please join us. So it's a relatively short amount of time to get through quite a good range of perspectives here, but we've got an excellent panel representing a good cross-section of the market, really. So what I want to sort of focus on initially is sort of where's gold at the moment? Do we feel that maybe gold has underperformed against other commodities? The price remains quite strong. The profits seem to be there. There's a lot of interest still, but when are the share prices really going to take an upturn? And I guess I'll start down here. Terence.
Try predicting what's going to happen in the gold market. I don't know. As you say, gold's been pretty strong, surprisingly so. We are seeing a lot of underperformance in both the miners. I think the WHO has dropped about 8% this year, and so has the venture index has dropped about 8%. So there's not much, there's not really much choice being made as to whether you go into exploration companies or mining companies. This underperformance is I think attracting a sort of a generalist type of investor at the moment. We've spoken to a couple of those in sort of peer conferences. And they are only going to look at mining if they see an undervaluation. So I certainly feel that there is opportunity for a good re-rating in this sector. Obviously, I can't be predicting when that's going to happen, but I feel it looks a lot like what was happening at the end of 2015, beginning 2016. See a lot of similarities there.
Okay. Interesting, the generalists are sort of having renewed interest, particularly in gold. Angelos, as a specialist and one of the best performing gold funds out there, what's your take?
Well, it's a very strange environment. I agree. It has to do with the conviction of where gold prices are going next, and I think none of us has a clear view of what's going to happen. We actually are quite bullish on gold because of the macroeconomic environment, the debt problems, the instability in general about the trade wars and all the geopolitical risks that are coming up. Plus the fact that the general equity markets appear to be on an inflection point, if you like. I think most of commentators agree that they've been pushed to these high levels because of quantitative easing and the liquidity. Yet sometimes, people think that they may be overvalued at the moment and subject for a correction. So, if the markets enter a true risk-off mode and the general equity is correct, I'd like to think that gold is going to be inversely correlated and break this 1360 limit, resistance level that we have all been watching, and then we should go up to 1400 plus very easily. So in that environment, obviously the generalists will start getting interested in the equities again. I think everybody agrees that the mining equities have restructured, the mining companies have restructured their balance sheets. They are much healthier now. Even at $1,300 per ounce, they are making very good margins. So the businesses are sustainable, even for a brief period of weakness in the gold price. And that should really attract the interest of fundamentally driven investors. I think it is likely that they will look at the producing companies first, and then when that valuation gets more fuller and re-rated, then they will start looking at the smaller ones. So we probably have quite a long period of pondering and indecision ahead of us.
Okay. Torsten, you're coming at this from a more macro commodities perhaps approach. And last time you were with us, you were with Tiberius. And could you just explain your current role with Linkius, and then take us through your sort of markets view on gold?
Yeah, thank you. Yeah, When you're looking at the precious metal sector, I'm more coming from the top-down side, analyzing the commodity market, then digging into the companies. And I think the easy trade, we all agree, was the 2016 story, when we see gold mining equities were trading at levels what we've seen like more than 20 years ago. Market capitalization of a gold mining space from that point was at price levels comparable in a gold price about close to $280, $300, and not what we've seen at $1,280. This was a really amazing opportunity, but exactly the same what we have in the moment. Investors are very biased. Either we see gold in the moment at $800 or like at $1,400 to $1,600. So there's a very positive and a very negative community for the gold sector. And this is also on the technical pattern. When you see like a long-term price development, one of my preferred charts, or I normally bring them around, is this one, where you see like the commodity market against commodity, so commodity prices in general, like energies, metals, precious base metals, also the X, compared to equity valuation. Matches what you just said, that we've seen the catalyst for equity markets. Equity markets in general look a bit toppy. And what you see here in this chart, but we've never seen general commodity markets that inexpensive compared to equities in the last 50 years. So we had 3 tops in the last 50 years, measured from the 1970s on, compared the GSCI commodity index as a ratio to the S&P GSCI on the equity side, and 3 highs were oil crisis, the Gulf War when oil shot up, and the commodity super cycle. And then the bust of a super cycle with a financial crisis. So when you see now, commodities as a whole look cheap. When you're looking at precious metals have very good fundamentals when you look at the gold price, interest rate environment versus inflation versus equity valuation. But the scare factor, the fear factor is pretty high in the moment, and that's what we saw in the last 3 days. Gold was approaching 4 times this year, this 1360, 1380 level. It's really like dancing around this and trying to break through. And I think if this level is not holding anymore, and 1415, 1550 definitely is very fast in the cars for a gold investor. This is a very splendid time for the gold mining sector, gold and silver. Because if you can flip like 2 pages, I just would like to make one more. I would like to make this one clear for every investor, that the potential for the mining equities on the gold miners is this huge discount to the gold price, to the silver price, and to mining valuation. So if gold is staying at this level and even cruising higher, and the gold mining sector sentiment clears up, gold miners are making money at this level, the margins are positive, but the capitalization and the investor sentiment is that the gold mining sector is loss-making. So this huge discount could be replayed, and then we see like a 10% move in the gold price translating into 30, 40% on the gold mining sector easy. And that's basically, and hopefully, a strategic trade for 2018.
Very interesting. Kathy, what's your take on that as head of research at Patterson's?
Well, I've covered the gold sector for 30-odd years now, and we haven't had many moments in the sun, I must say, over that period, but I think it's looking fantastic at the moment. I mean, looking at the ASX stocks, the top stocks have actually had a phenomenal performance, the Northern Stars, the Evolutions, and to the extent that I wouldn't agree that they're all trading at value at the moment. We've got typically those stocks trading at over 2 times an MPV valuation, and over the 30 years I've covered the sector, that's really the peak. I haven't really seen it much higher than that ever. But looking down the track to the 100,000 ounce type producers and the developers, I think we're going to see some rotation from the larger producers into these. And we've done a lot of marketing. We've got our resources handbook at our booth at this 121 conference. And having done a heap of marketing around that the last few weeks, we're really seeing a renewed interest in the smaller caps, and even from the Australian generalists. And certainly we did 121 in Hong Kong as well, and went and saw a number of Hong Kong funds. And similarly, we really are seeing a surprising appetite for the smaller guys. And also, I think if you're looking at the battery metals guys, we're seeing concerns that, say, lithium, quite a few of these ASX stocks have had massive runs, and we're seeing sector rotation out of those names as well. And I think the final point to make is that the whole gold sector is in actually very, very great shape at the moment. Most of the balance sheets have been shored up. They've been building cash. Average all-in sustaining costs in Oz are about 900 to 1,000 US. So they're building very good cash. We've been very lucky with the impact of the lower Aussie dollar. So we've had that double whammy there, that we're really building very strong cash. And I think we've also seen a flight to quality with management, and I think over my career there's been some pretty disappointing times when it was growth for growth's sake, and we saw a lot of blow-ups, and now you're seeing a lot more conservative management, happy to reduce the ounces in terms of giving a much better outcome for their shareholders. And I think it's a really positive space to be in at the moment.
Excellent. It's very encouraging to hear that. And Kagan, what's the view like from the company side of things? Sounds pretty positive so far, but you guys recently listed, and what's your take on this market at the moment?
Yeah, thanks. I'm actually a mining engineer, so working on the exploration side. It's not really the right person to do the job, but it's a very interesting career. I started, working on the gold industry 20 years ago. Since I moved to Australia from China, I used to work in coal sector. But the gold, when I started working on the gold industry, the gold was at $250 per ounce. Then when I'm doing long-term planning for Zimbabwe, 12 years ago, it's come to 700 ounce. Now it's 1,300 per ounce. So we definitely see the trend. So investment in the gold sectors, I think it's really for the long-term purpose, not really for the short-term gain. Gold is not really a pure industrial consumable materials. It's a very special metal. So its value is there. But if you look at the discoveries in recent decades, big discoveries get less and less, and the cost of discovery become tremendously expensive now. So I think as demand is still there, we see the increase of the global production over the last decades, but the price is also increasing. So I think so overall, if we look at the long term, we should be all very positive. It's tough to do exploration. From my personal experience, I can feel it. We were in private for 7 years to define the resource to near 1 million ounces and get listed in January this year. So it's tough business, but it's a very, very challenging and exciting job for us, and I think we should all be quite positive for this sector.
Okay, wonderful. I'd like to focus in now a little bit more about the sort of selection process, or sort of what you look for in the company. So, Terence, maybe talk us through whether there's certain criteria that get you excited, or what really works for a Commodity Discovery Fund.
Okay, so we focus on exploration companies that will find the next world-class deposit. So that's an easy model, isn't it? Obviously, there's not many companies that will actually achieve that, but we do, we do get in on companies that make discoveries. It's sort of a high-risk area. I know you were telling me, Angelos, that you're sort of further downstream more to the producers or the startup producers. We like the risk that is apparent there because of the potential for the returns. Obviously, those companies are much more leveraged than the miners are. We saw that in 2016 when in sort of that first 6 months we saw the miners rise about 100%, and our exploration companies in the portfolio rose about 300 to 400%. So we like those leveraged plays. We're also looking for those companies to get taken over, because we've seen during the course of the existence of our company that we've had 45 takeovers in our portfolio, and they have averaged during those 10 years a return of 70%. So that's a fairly good performance, and that's despite a 2008 credit crunch, despite the 2011 to 2015 downturn that we've seen, which was even more value destructive than the credit crunch. Despite that, we've had that 70% returns on takeover. So that's why we focus on high quality projects, takeover potential, and we find that the companies that get even more than those 70% returns are the sort of the grassroots discovery companies rather than the brownfields takeovers. So grassroots is what we focus on, and that requires looking at management teams that have a very good sort of sense of geology, have a very good expertise in geology, but also companies that have a knack for getting hold of finance when needed, for being able to market the company, and eventually down the road for being capable of negotiating a takeover. So it's those traits, the combination of a good project and a good management team. I mean, they're cliches, but there's not too many, those combinations around is what we look for in our selection process.
Yeah, and so just to sort of touch on that a little bit better, so the greenfield sort of exploration plays. Are you seeing a lot of those around? We had an exploration panel yesterday that was saying, that the industry's quite lacking in quality economic discoveries, as it were.
Absolutely, because I mean, the two downturns I just mentioned over the last decade have caused sort of a lack of money going into exploration itself, and you see that now. There's not too many real discoveries coming forth. We saw last year, but there is a group of investors that are ready to pounce on that. So there's hope. We saw last year that there's a couple of companies like Garibaldi that rose a tenfold on the back of a nickel tenor that was published. We saw New Nadina that rose a tenfold on the back of visuals of the core. What else did we have? We had Nova Resources returning results from bulk sampling. And this year even we saw Evrim Resources rising fivefold on trend results. So there is an appetite for those kind of discoveries, and you might even argue that they are not yet discoveries because they haven't actually, they haven't even come back with good assay results from the drill bit, which is the proof of the pudding. So there isn't much, but there is a group of investors that are looking to invest in that. So we'll encourage everyone to go out and find that next big deposit there.
Excellent, encouraging signs. So, Angelos, you're a bit more downstream, as we mentioned, but what's your sort of criteria in terms of what you're focusing on? Is it very much the small caps within that, or?
Yes. Our junior gold fund is essentially a sector allocation tool. It has daily liquidity, so we have to maintain certain liquidity thresholds if not only for compliance, but also for the general management principles of the fund. But we also evolve the portfolio in relation to the market cycle. For example, in 2015, at the bottom of the bear market, we were exclusively focused on producing companies that were reducing their debt, paying attention to costs, abandoning the ambitious marginal projects, and really it was housekeeping and keeping the windows tight. And that strategy paid off very well in 2016 in the recovery rally, because those were the companies that were looked at by investors in general first. Now, we are moving a little bit further in this current market in the hope and in our belief that the gold price is likely to rise to higher levels. So our sweet spot in the last 12 months or so has been the development sector. So the companies that have gone beyond the feasibility study, that are raising the financing, that have a very clear visibility to production. And I tend to feel that these are going to be the takeover targets of larger companies that have been starved of reserves, have been starved of future production, that are running at very low reserve replenishment ratios. So it's an evolution. I think if we break this magical 1360 resistance level and run to 1450 per ounce gold, of course, the earlier stage exploration plays will fly, and we'll see, investors will see multiple times gains. But you mentioned some successful companies, and indeed there have been some very successful examples in the exploration segment of the market, but they are very few and far between. There have been so many disasters at the same time. So unless you have a very carefully selected and diversified portfolio of earlier stage projects, you are likely to make money on some and lose most of your gains in the one that goes under. So that's the great risk in this current market, where there is not enough interest by generalists and there is not enough interest by the broader market to support valuations. Liquidity vanishes, and then you're also locked. You can't get out. So we'd rather have a more sort of sensible, risk-averse model. First of all, we avoid political risk. So Russia, the stance, and other politically unsafe areas are out of the question. We take enough risk with the commodity as it is. We like to have this mix of producers that have strong growth models and some development stage companies that are likely to be attractive takeover targets.
Interesting. Kagan, just as the miner, what do you see as your biggest risk at the moment? We're talking about, mentioned as sort of few and far between for the really good success stories. How do you feel around that comment as the gold miner?
Yeah, it's I think from scratch.
Sorry, hold the mic.
Sorry, yeah, from we actually all our projects in Liberia and Côte d'Ivoire started from license applications, and from put applications to deliver resource, and later hopefully we can deliver to a mine. It's a long time and lots of risk involved. For example, in 2014, the Ebola comes out in Liberia. Unfortunately, we expanded to Côte d'Ivoire 2 years before, just at the end of the Côte d'Ivoire crisis. And we went there a bit earlier than the rest, so we fortunately applied a good license in Côte d'Ivoire. But we also have other risk of one of our projects was in the reserve. We drilled nearly 9,000 meters, and then we couldn't do any work. We still have full security people sitting there for the last 2 years. Now we have to focus on other projects. So lots of risk exists, but we don't know when that would happen and what kind of risk would occur. But I think the thing what we are doing is I think, work on a number of projects, but don't lose the focus. For us, we are focusing on gold projects in West Africa. So we have a number of projects in our pipeline, and at a certain time, we're probably working on one project and try to deliver as much as we could, but never actually minimize or never actually avoid completely the risk, particularly the political side, particularly junior companies. We have a lack of strength when we make a voice, but for us, we have a very good support from both countries. But nevertheless, I think it's always keep in mind the risk does exist, because the project from scratch to producing, it's covered more than 10 years, 15 years maybe, and during these 15 years, all sorts of risk will come. But keep in mind, wherever we do, actually make sure you do good communications with different level of government and the communities. I think you will receive good support from all levels, and at the end, you still have the projects. So that's the key I would like to make.
Okay, interesting stuff. I'm conscious we spoke a lot about gold, but we've titled this a precious metals panel. Torsten, I just wonder if you got any views you could add on silver here.
I mean, talking about the silver, it's a top-down decision. What kind of precious metals you like, and what are the macroeconomic forces behind it. What we've seen in the last weeks is the first sign of an outperformance in the silver market. And when you compare the long-term chart of, for example, the gold-silver ratio, indicating what is cheap, what is expensive, gold or silver, you saw over the last 2 to 3 years that gold on the first hit was massively outperforming the silver market. Normally, if you have a precious metal bull market, the smaller metal with a higher beta, of course, is better performing and giving you as an investor in the companies a better leverage on the silver names than on the gold names. Of the cost of a higher risk, obviously, but in terms of a higher risk-return profile. So therefore, in the moment, as we just turned the corner on the gold-silver ratio in the multi-year, 30-year horizon, you see silver companies start to outperform after being a disaster for a couple of years. Looking, for example, at some Guatemala project, I don't need to call here some names, but also like a big recovery afterwards. And we at Linkeos, for example, focus after the metal on the companies who are producing, who are already in the phase about earning money. We like cash flows. In this environment, we focus on the companies who are marginal profitable and give basically you as an investor the rise about the metal with the highest leverage. So we're not as competent to get into the development and early stage exploration. That's not the core competence of a company. But if you have a rising silver market, a rising gold market, and the margin is exploding, it gives you, from our view, enough leverage on that one.
Excellent. We've got about 5 minutes left. I want to open to the floor if anyone's got any questions for our panel here. We've got a great selection of expertise. Does anyone have anything they want to put to anyone? All good for now? Okay. I wanted to ask sort of what's your view on what companies should be doing now? Kathy, you work with a lot of companies, you review a lot of companies. If you had any sort of advice for the mining companies out there or those you've seen today from what you're seeing in the markets and your research, do you have any sort of messages there?
Well, I always think that it's very important to look for projects which have got lowest quartile to mid-quartile operating costs. We're seeing a lot of restarts of old mines at the moment, and my experience is a good old mine tends to become a good new mine, and a bad old mine, it's pretty hard unless there's a major step change in technology for it to actually, even in a much higher priced metal price environment, be highly successful. Shore up your balance sheets, which I think most people are doing already, but I've seen so many times that people think that there's days in the sun and they don't really need to raise money, but when your back's against the wall and you need to raise money, you're going to be diluting your shareholders and potentially yourselves a lot further. And have a clear strategy in mind. I think as an analyst, it's very frustrating when I see a miner who really just keeps exploring for exploration's sake and doesn't have a strategy as to what size they really want to get this potential drill target up to act and get it into production. I mean, we really want to see an outcome. We've seen a couple of the institutions really push back on the miners to say, look, you're paying a royalty to most governments, we want to see a royalty come out to our shareholders. And I think that's the focus that we've seen some really undervalued stocks which have turned around and used their great earnings into some really bad investment. So really look to your shareholders as the stakeholders in your business, and they do need a return.
Fantastic. Terence, do you have any particular...
Well, obviously we're biased towards the exploration side of things, and I would encourage companies to spend money on exploration, but as Kathy says, it's not just for exploration purposes, it needs to go somewhere, so that the companies need to focus on building good exploration teams, good exploration models, get outside expertise, and I think that's the only way. And don't focus on the mediocre projects so much, which we see a lot of. So we won't invest in them.
Sure. Angelos, any special messages for the mining companies?
Well, as always, the project has to be right, and we see a lot of very questionable attempts to bring back projects that were perhaps marginal in the past, and some teams picking up those projects, hoping that the price of the commodity is going to bail them out. So really focus on the fundamentals, on something that is robust, even in a weak price environment, and has a lot of sustainability, a lot of control even in a weak price environment.
Okay, we've got about a minute left. Why don't we wrap up with some thoughts, crystal ball here, around pricing, gold price, where we think it's going to break out or what it's going to do in the sort of short to mid-term. Let's work our way down. Kagan, do you have any thoughts?
And we think we keep a moderately positive for the price, for the gold price for this year. From long term, we think particularly maybe next year, after next year, the gold price should go up quite substantially, mainly because of lack of reserve resource discovery in recent decades.
Kathy, any thoughts?
I'm quite happy with the price where it is at the moment. It's nice to see some stability. I think volatility isn't always a great place to be. I would say that if anything, there's the risk on the upside rather than the downside with political instability. But the fact is that most of the gold producers are enjoying very good margins at the moment, and if it tracks around 13 to 1400, I'd be very happy. I mean, it's always nice to see a spike, but it's far easier to be getting investors in if you've got a more solid price rather than a volatile price.
Torsten?
Yeah, maybe also as investors not to forget that there's good volatility and there's bad volatility. Yeah, I like the volatility on the upside, as everybody does. Also on the gold projects, when we have a low price environment and we're on a sustainable path, living, just making the money, making the living, it's not very exciting for anybody, not for investors, not for the management, not for the employees. So therefore, I think the core is here, get the commodity right, get the timing right, and then look at the companies. And looking at the gold and silver market in the moment, it's a bit shaky situation, as we tested this $1,360, $1,380 level on the gold price from a technical view 4 times this year. Lots of fundamental factors are telling us that this level should be the next, after the next resistance, the next support, and we've seen much higher gold prices. Despite me being from Germany, living in Switzerland, I'm more on the optimistic side of things. So therefore, I'm on the side of a more positive environment for gold. So therefore, I'm in the sector.
Guys, very, very quickly, if I could get 10 seconds each.
Sure. There is no crystal ball, of course, but I have been on record several times this year that we'll see prices well above 1,400 before the year end. And my view on that is because of the looming bond bear market. We see treasury yields rising rapidly, breaking new highs. There is a massive issuance of treasury bills by the US administration, double what they issued last year. And at the same time, the central banks are unable to raise rates very rapidly. So this real interest rate environment is very constructive for gold.
So I'm not an economist, so I'm a bit out of my league here. Personally, I don't see many triggers to move gold either up or down. I'm quite comfortable as it is now. In the long run, I do see the unviability of this whole financial system, which is should be further down the road, a good trigger for price appreciation, sort of significant price appreciation in gold. When that's going to happen, we don't know, but I'm quite convinced that it will happen sometime in the future.
Excellent. So we're all waiting out for when. Excellent. Well, look, round of applause for our panelists. Thank you very much.